You're listening to the Scotiabank Market Points podcast. I'm your host, Greg White. Market Points is part of the Knowledge Capital series, a collection of audio, video, and written commentary from Scotiabank global banking and markets leaders designed to provide you with timely insights and analysis. Sustainable finance is on the rise. Corporations and investors have recognized the connection between sustainable practices and projects and overall global economic health. And the market has responded with financial instruments specifically created to support sustainable initiatives. Fanny, Doucet, and Jason Taylor are both directors leading the efforts of Scotiabank's newly created Sustainable Finance Group. In this episode of Market Points, I sit down with Fanny and Jason to better understand the framework for sustainable finance and to discuss the important factors affecting its future. Hi, Fanny and Jason. Thank you very much to both of you for joining us on the podcast.
Thanks, Greg. It's really exciting to be here with you.
Yeah, same here. Share the same excitement. It's nice to chat together on these topics. Looking forward to it.
Wonderful. Let's jump right in then. Jason, for some of our listeners that may not be as familiar with sustainable finance, perhaps you can start us off with a discussion about what actually defines sustainable finance, and then walk us through some of the factors that have been contributing to the sector's recent growth.
Yeah, sure. Would love to. So I think a good place to start is just to talk a little bit about the various acronyms that are out there that been potentially have caused some confusion with people in the market. And oftentimes they appear related, but when in reality they often have important distinctions. So ICMA, which is the International Capital Markets Association, which has been overseeing a lot of the governance in the sustainability market, has recently published some guidance just to help clarify some of the areas, just so that people are able to understand some of the nuances between, for example, sustainable finance, ESG integration, or areas such as social finance. So in this particular case here, sustainable finance, it can be defined a couple of ways, but one, really the way we view it is funding that's policy aligned. So definitely funding that's aligned either to the Paris Agreement, its 2-degree scenario, or the United Nations Sustainable Development Goals. And also would probably add that it would be overseen and governed by ICMA's evolving sustainability principles, whether we consider green bond principles, social sustainability, or KPI-linked principles they recently launched this past year. If we bring that definition into a local context here, the Canadian Expert Panel on Sustainable Finance defined it as capital flows, risk management activities, and financial processes that assimilate environmental and social factors as a means of promoting sustainable economic growth and the long-term stability of the financial system. So, with that said, I think that sets the table or a backdrop to sort of add some context around the discussion. And, I'd be happy to migrate into the growth and the assets under management. The short answer is many drivers are affecting this growth. It really feels like the market's achieved an inflection point. Dialogue in the community is becoming more centered around mainstreaming. I think, if I'd had to isolate a couple of them that are sort of responsible for a larger part of the story, it would definitely have to be the evolving dynamics of climate change risk and opportunity. Long held view that it was long-term risk, and with the increasing frequency of extreme weather events and some of the transition risk is accelerating, it's definitely it raised a lot of eyebrows in a sort of systemic way across capital markets. So, and then with that, obviously, it's only natural to see government policy follow this and adapt to some of these larger macro themes that they wrestle with on a day-to-day basis. So, we can just very quickly just look at the Green New Deal in Europe, or even in the U.S. Joe Biden recently announced a very ambitious environmental platform, just to name a couple of many policy examples that are sort of driving this. I would say that the price of carbon in Europe recently attained new highs. We use that as a proxy for policy and the sort of acceleration of the entire industry, and it's largely a function of the two previous factors. And then also, if we look at some of the bottom-up sort of factors such as consumer demand and demographics, these are also two really important factors that are sort of nudging the market along. Consumers more and more are making voluntary decisions to change some of their consumption habits, and the easiest example for us to talk about or think about is the electric vehicle space, and even in terms of some of the circular economy type of initiatives and recycling and things of that nature as people attempt to reduce their own environmental footprint. And then I'd say probably the fourth one, which is also going to be something to keep an eye on here, is the evolving demographics, the famous great generational wealth transfer that people often refer to, where boomers are expected to leg a record level of financial assets to their offspring. So, and this is a demographic cohort that's very sensitive to these topics. So, I'd say those are the four main reasons. There are other ones we could also discuss, but if we wrap all that together, it's definitely would explain the growth in the assets under management and how financial institutions are quickly pivoting and mobilizing around this area.
There's been tremendous new uncertainty injected into the economy, obviously, because of the pandemic. Fanny, how has the COVID-19 pandemic impacted the sustainable finance market?
Yeah, sure. That's a really great question, and obviously something that's really topical. We saw a few different things come out of the COVID-19 volatility. I think looking back when the volatility first hit at the end of February or early March, companies and entities became hyper focused on just how to get funding in the door and kind of put aside what that funding looked like exactly and how it was labeled. So as a result of this, we did see a decrease in labeled sustainable finance issuance, especially from companies or entities that didn't have platforms in place already to be able to issue in the sustainable finance market. They were very focused on how much access they had to the capital markets and at what cost, and getting that in the door. So that resulted in really a slowdown of the pace of issuance in the sustainable finance market. That's the first time it's happened, I would say, since the creation of sustainable finance and since green bonds, for example, were first issued. So quite a notable change. However, I think on the back of that, what we've seen with the focus on COVID-19, the impact it's had on people's lives, the impact that it's had on economies globally, is an increase in focus on social factors. So historically, the sustainable finance market was really dominated by green issuance, or focusing in on the E part of ESG, or in the environmental part of it. So, for example, green bonds have historically consisted of about 70% of the sustainable finance market from a debt perspective. So since the onset of COVID-19, we've seen a tremendous increase in social funding, or bonds or loans that are raised to finance projects that have a social benefit. A lot of that has come in the form of COVID-19 funding. So whether it's by governments that are aiming to fund their stimulus packages that they're providing or supporting their economies, or development banks that are helping nations that might not have the ability to fund themselves throughout this pandemic. Or we've seen even some corporations like Pfizer did a social bond where part of the proceeds was going to fund the research and development around a vaccine for COVID-19. So a tremendous increase in social issuance. Focus on COVID-19, but I think in the future, it's really going to have an impact on how investors look at ESG. And again, not just focus on the environmental part, but increasing their focus on the social aspect as well. We had another interesting transaction come to market. Toyota Motor Company, they were in the bond market in the US. One of the tranches that they funded was a diversity and inclusion bond. And so with that bond, they had book runners that were banks or dealers that were either minority or woman-led dealers or banks. So something very novel. We don't see that often. Toyota had issued these types of bonds before, but I think it was a nod really to the political environment that's going on, particularly in the US, around diversity and inclusion. So I think going forward, that's also going to be a really big topic. I think it's interesting overall to see how quickly the sustainable finance landscape is adapting to changes politically and what people are really caring about. It's really not taking long for new products to come out to support new social causes, which I think is really positive to see.
Fanny, do you think that there's a intersectionality then between the environment and social elements?
I do. I think, for example, when we think about having to kind of rebuild from this pandemic, I think there's a lot of discussions about, okay, how do we rebuild this correctly from both an environmental and from a social perspective. So I do agree with that. I think those are going to become more and more intertwined. But again, just the focus not being squarely on the environment. Climate change is definitely a big topic, probably the biggest topic of my generation, and something that we definitely need to fix, but not losing sight of everything else that we can be working on as well.
So, when it comes to all the various categories that sustainable finance can support, Jason, how can investors be confident that the bond they are purchasing doesn't just have some sort of marketing label attached to it, but that the funds are going to the intended projects?
Yeah, great. Thanks, Greg. And it's a great question. And if you don't mind, I'm just gonna broaden out the topic and attach it and address it in parallel to sort of a greenwashing discussion. So, and definitely will address the bond level aspect of it more specifically. But I think, generally speaking, I think we've all seen a fair amount of headlines around perceived greenwashing allegations really across the entire economy. So it's not necessarily only specific to the bond market, but there's been sort of greenwashing incidences at various organizational levels. So, at least in a capital markets context, it's something that here that we're extremely sensitive to, mainly from the view that we simply want to preserve the integrity of the market so that it can grow and prosper in a really high quality and healthy way. And it's really necessary if the necessary capital we need to mobilize around these objectives is going to materialize over the coming years. So really, in order to do that, it's everybody has to work together to make sure that transactions and reps and claims made by any type of participant is really has legs to stand on and validate and support that. So as it relates to the bond market more specifically, ICMA again has provided a lot of leadership and tools and guidance around ways that some of this greenwashing may be mitigated. So in one of the green bond principles, it requires for mandatory annual use of proceeds reporting. But I think the market's evolved from meeting the minimum requirements and is pivoting towards more of a best-in-class model where companies and governments are really using everything at their disposal to signal and communicate that they're committed to high standards. And one of the ways that we're starting to see this area addressed is with voluntary proceeds and KPI reporting that issuers now are also asking their auditors who are now developing carbon accounting budgeting abilities as well to just sort of kick the tires and verify some of the claims that are being made. And although it may seem at the outset to be a bit of an administrative burden, but in reality, there's quite a few synergies that permit an issuer to extend this with relatively little effort, but that goes so far in the market in terms of creating and establishing that widely important trust. So with that said, though, I think ICMA's definitely taken a continuous improvement mindset, and every year in their annual general meeting, they're always presenting and providing the market with new initiatives that really help to tighten up these transactions, so that this greenwashing risk can be mitigated to its greatest extent possible, so the market can continue to prosper.
And I would also add on to that, Greg. We spoke about earlier regarding the proliferation of funding to fund social projects and the movement away from just green bonds. That is another trend we've been seeing overall in the sustainable finance market is an increase in the number of types of financing products that are available to companies and entities in the sustainable finance world. And I think as we develop those products and make sustainable finance accessible to more types of companies and more types of entities, and moving away from really the pure green issuers or really the pure social issuers, but really being able to reward companies or entities that might not fall into either of those, but are really making great strides to make themselves more sustainable. I think what we'll see and what we're already hearing from the investor space is they want an increased sense of accountability and increased transparency. So in order to provide for more innovative products, to allow for more different types of companies and different types of projects to be funded, they're comfortable with that as long as they're getting enough information to make their investment decision and make sure that what they're investing in and what they're financing is really value added and saying it's going to be funded and will fund projects that are supportive of the initial goals.
Turning to Canada, as Canada continues to grow in the sustainable finance market, how will transition finance play a role domestically?
Yeah, I think Canada, it'll be interesting because the way that Canada's economy is structured, being a really resource dependent economy, means we have a different profile of types of issuers versus Europe, for example, which has really been on the forefront of sustainability and of ESG. But we have to think about how we can support the companies that we have within Canada. Transition finance, I think, is one of those ways. It's a newer type of product in the market. It's been used in certain bespoke circumstances, but I think is one that is really primed to develop. So transition finance is really focused on those issuers that are working on a lot of projects and making great strides in reducing their footprint from an emissions perspective, and instead of and therefore not issuers that are entirely eliminating them. So not focus on the green economy. But I think there's a lot we can do. There's a great environmental benefit to focusing on companies that can become better and more efficient at doing what they're already doing. And because Canada has a big resource economy with the energy industry, I think there's going to be a lot of appetite for this kind of financing. So I think it just takes an issuer and some investors that are willing to be the first to kind of test this out in the Canadian market. But that's definitely something we're focused on and seeing where that market can go.
That was Fanny Doucet and Jason Taylor, both of Scotiabank's Sustainable Finance Group. You can find more thought-leading content from Scotiabank on our website at gbm.scotiabank.com, and you can also follow us on Twitter at ScotiabankGBM, as well as our LinkedIn showcase page under Scotiabank Global Banking and Markets. Please refer to our legal disclosures on our website. Thanks for listening.